Why, hello there, Hector Davil here. Welcome to this new video and this whole new topic actually, because, well, we're gonna be talking about something completely different from now on. Over the past few videos, we've reviewed how to trade the swinging pattern, okay? How to trade pullbacks to the dynamic area of support and resistance in order to trade whole new swings in the direction of the trend, right? Well, now we're gonna be moving on to the next topic, the next type of trading. Breakout trading, okay, or the staircase formation, as I like to call it, where price gives us a pullback, a push, a swing in the direction of the moving averages, but instead of giving us then a pullback, price simply meanders sideways within a congestion area, okay? Then we get a breakout, off it goes on a whole new swing, and then a little bit of sideways price action. The moving averages catch up with price once again. The trend, well, basically muscles price to break free from this sideways congestion area, and off it goes for a whole new swing, and so on and so forth. Now we are not going to be trading bounces of the dynamic area of support and resistance. Instead, we are going to be trading breakouts, okay? Breakouts of this sideways congestion area, okay? These areas here, I mean, by the way. Okay, so the idea here is that as the former swing dies out of steam, instead of getting a pullback, price begins to simply flip-flop sideways. Okay, to simply, simply crawl sideways, no momentum whatsoever either to the upside or to the downside. In fact, you will see that more often than not, price simply compresses within two horizontal boundaries, okay? And then as the moving averages catches up with price, they kind of, well, bang, muscle. Remember that the moving averages represent the trend, especially the dynamic area, right? So as the dynamic area catches up with price, well, we usually see price breaking free from this congestion area, gathering momentum again for a whole new swing, and so on and so forth. All right, now there are a few different shapes this congestion area can take, and I should have them somewhere in here. All right, here we are. Okay, these are the three most common shapes we can see around the congestion areas. Okay, these congestion areas in here. Okay, well, like I say, price can take three different shapes. Either ranges, where price simply bounces up and down within two horizontal boundaries. Okay, triangles, where price compresses within two opposite trend lines towards the vortex, and then flat triangles, where, well, we have one trend line and then we have one horizontal line. Okay, basically this trend line compresses price towards the horizontal level. Okay, these are the most reliable shapes of all. There are obviously more shapes out there, such as, for example, the expanding triangle, where price obviously enters the range from the left, and from there, well, we simply see expanding swings both to the upside and to the downside. All right, and therefore, well, the triangle keeps on expanding on and on. This type of shape is just, I've never been able to, I'll be honest with you guys, I've never been able to sustain any decent results whenever I've tried to trade expanding triangles. Okay, like I say, I've never been able to make consistent profits out of that shape, and therefore I am not going to teach you anything regarding this shape at all. Then we also have what in the trading lingo it's called the diamond. Oops, sorry about that. The diamond shape, where price begins to expand, okay, in a like in an expanding triangle, and then it begins to compress like in a standard triangle. Again, I've never been able to sustain any decent win-loss ratio out of this shape at all, so I'm not even going to mention it. Again, the three most reliable shapes in my experience are these three, and these are the three I am going to try to teach you over the following minutes. All right? Okay, an important concept I really want to go over here is that they break out ideally, again, ideally, should happen as the dynamic area catches up with price. Okay, please mind that the dynamic area represents the ongoing force, the tide, the current of the trend, and therefore you want to, well, you want to muscle price, okay, to push price away from this stagnant price action. Okay, so as the moving averages catches up with price, you want to see price breaking free from this sideways price action. Obviously, it goes without saying, should you see a breakout to the downside, meaning against the trend, you would not be looking to trade that breakout. Again, we are only going to be taking breakouts in the direction of the trend. But again, what I want to stress here is that that market event, that breakout, should happen as the dynamic area catches up with the congestion area, bringing price alive so it gathers momentum enough for a whole new swing. That's the ideal situation. Okay. Oh, by the way, that's equally valid no matter whether we are facing a sideways range, a triangle, or a flat top triangle. Okay, in no matter the shape the sideways price action takes, the core principles are exactly the same. Now, as a good old skeptic fella, you are probably wondering, well, Hector, what does it matter? What does it matter whether the range is down here just off the dynamic area, or rather the breakout of the range takes place right off the dynamic area of support and resistance, or whether the breakout takes place when the range is up there? Well, there is a big difference here, and I'm talking about risk management here. We've already seen this concept before when we were explaining the swinging pattern. Remember that I was advising that your entry should be closer to the bounce point than to the previous swing high? Okay, that we were marking this distance, or rather the 50% range of that distance, and we wanted to make sure that our entry was in this junction, in that portion of the swing. Okay, we were also mentioning that the farther away within the swing, the farther away you enter the trade in that swing, the higher the chances that sooner or later you will see price or the swing running out of steam, and therefore either retracing back down or simply stalling sideways in another congestion area, right? Well, obviously, both the scenarios are certainly counterproductive to your best interest. So in order to avoid that, you want to make sure that your entry is as close as possible to the dynamic area, okay, to the bounce point. Well, this is pretty much the same thing, all right? Make sure that the breakout, and therefore your entry, is going to take place as the moving averages, or somewhere around the moving averages, okay? Not too far away, not too far up there, probably almost at the top of the swing. That would be terrible to enter the market at the very top of the swing, okay? Don't risk that, and the very best way to avoid that potential risk is to make sure that you only take trades, only take breakouts that take place off the dynamic area, all right? Okay, now, so as price begins to break free from the congestion area, how do you enter the market? Okay, how do you jump into that trade? Well, we are going to be using a pattern you are already familiar with, the breakout pullback continuation pattern. If you remember, when we were, studying how to enter the market on the swinging pattern, we were drawing, one of the possibilities was to draw the retracement trend line, okay, and then wait for a breakout pullback continuation pattern on the trigger chart, okay? Please remember that the breakout pullback continuation pattern is just the confirmation of a breakout from a technical point of view. It doesn't matter whether you are breaking free from a retracement trend line or whether you are breaking free from a horizontal line, okay, from a horizontal level of support and resistance, such as a range boundary. At the end of the day, the nature of the pattern is exactly the same thing. It's basically confirming the breakout from a technical point of view, and that's why we are also going to be using this pattern in order to trigger our entries as price breaks free from a congestion area. So as price begins to tick above the range boundary on the setup chart, we zoom into the trigger chart, okay, into the shorter time frames, and we wait for our standard breakout pullback continuation pattern. Okay, obviously the entry would be just above the breakout thrust, okay, right there, and our stop loss would go immediately below the pullback aspect of this breakout pullback continuation pattern. Okay, there are three phases, three steps, let's say, on this pattern. We have the initial breakout, we have the pullback, and then the continuation. The continuation is what gets us into the trade just above the initial breakout thrust, and the pullback is what gives us the stop loss location. All right, now this initial breakout thrust, you want to see a solid candle on the trigger chart. Okay, you want to see a long candle with a full body, okay, breaking free from the range sideways boundary. That means that the breakout is taking place in heavy market volume. You don't want to see the pullback, the breakout taking the shape of, that type of a candle where the majority of the candle is actually the wick of the candle rather than the body in itself. Okay, you don't want none of that. You want a solid full body candle breaching through that congestion area, all right, that congestion boundary. Then maybe 1, 2, or maybe 3 small candles pulling price back to the to the range boundary, okay, driving price down, a little bit of a pullback to retest that range boundary from above, and from there, obviously you don't want price to dive back down. Instead, you want those 1 or 2 or 3 candles retesting and bouncing off the range boundary once again, and as the continuation part takes place, that's where you enter the market right there. Okay, that's where you enter the market right there, and that's where you place your stop loss. Obviously, should price come back down within the congestion area, okay, my rule of the thumb is that if price dives back down within the 50% range, okay, within the 50% boundary of the range, well, I would consider this that breakout as a failed breakout, as a fake breakout, so to speak, and therefore I would simply cancel any potential entry there. All right, so again, to recap a little bit, you want to see the breakout pullback and then indeed the continuation. If all you see is the breakout and then the pullback driving price beyond the 50% range, okay, of this entire range, well, that's a breakout. You will cancel any potential pending buy order that you may have at that level. Okay, this breakout is not pulling through, and therefore you are not interested in taking any further continuation move you may see from that point on. Okay, it's important to see breakouts happening in momentum. Okay, all in all, this is what the ideal breakout pullback continuation pattern looks like. Okay, again, solid breakout, 1, 2, 3 bars pulling back, pulling price back to retest breakout levels, meaning the former resistance level, and from there another heavy momentum filled full body continuation bar. Okay, pretty much the type of bar we saw as the breakout was pulling through. Well, you want to see the same type of bar also on the continuation part. That would be our entry right there, and that would be our stop loss down there. Okay, the pattern, the entry pattern in itself is identical, no matter whether you are trading the breakout of a sideways range, whether you are trading the breakout of a standard triangle, or whether you are trading the breakout of a flat top triangle. Okay, again, the entry pattern is exactly the same. Okay, now let's take a look at some live examples, shall we? We are looking into the euro against the American dollar. This is the intraday charts, by the way. It's a short-term trade, and well, as we can see, this is a beautiful trend. Okay, with those moving averages nicely pointing down, nicely parallel to each other, etc., etc. The trend more or less begins there. Okay, me actually scroll back, more or less begins there, and that's the first swing pullback, okay, the first price retest of the dynamic area. But as you guys know, we don't trade the first the first retest, right? So we let price go on its merry way, and then we see how price retests that dynamic area once again. However, please mind how we don't quite get a swing pullback there. Instead, price gives us some type of sideways price action, and more specifically, it's a range. Do you see the range there? Let me actually zoom in a little bit more. Okay, please mind how we have a triple point of support, okay, a triple swing point of support, and then also 3 points of resistance, okay, to the upside. So we have effectively an upper range boundary and a lower range boundary. That's just a range. Do you see how price is basically flip-flopping sideways all through the range? All right, not really a V-shape bounce. We don't have a harmonic swinging pattern there. What we have is a swing and a sideways range, a breakout, a swing. Do you see that? Okay, so obviously what we want to do is to simply mark the range boundary. This is the lower range boundary, which is the important one. As we've already mentioned, we are only to trade breakouts in the direction of the trend. Okay, so we don't really have to mark the upper range, but well, just for the sake of discussion, let's whoops, sorry about that. Let me be accurate with my range boundaries. All right, there we are. Again, resistance, 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 support, support, support. A range just requires 2 focal points to the upside and 2 focal points to the downside to become effectively a range. Okay, this time around we have 3. Well, the more the merrier, the easier it is to define the range. It's also usually a good thing to see those different swing highs and swing lows to line up rather accurately, okay? Because it's easier to draw the horizontal line, and therefore it's easier to determine the exact breakout point, okay? But at any rate, so eventually price begins to break free, okay? Please mind how the moving averages catch up with price and they muscle price, okay? As the breakout takes place as the dynamic area muscles price in the direction of the trend. That's ideal. That's exactly the type of breakout you want to see. Okay, so like I say, eventually we get the breakout out, and at that moment, as price begins to break free, we want to zoom into the shorter time frames. Let me now zoom into the shorter time frames and scroll forward. All right, there we are. So we have a breakout. We have a 1 bar pullback, 1-2 bars driving price back to retest breakout levels. Do you see that? How upon the breakout we get 1-2 bars pulling price back up there. Okay, even though price doesn't quite respect the former range boundary, right? Yeah, price overshoots that level for a little bit, but at no rate it dives or it goes all the way up to the upper end of the range. Okay, that never happens. Price never breaks the mid band of the range, and from there, well, it turns around and it gives us the continuation part of this breakout pullback continuation pattern. Our entry right there. Okay, right there. That's our entry. Our stop loss right there as well. All right, just above the pullback aspect. Okay, and that's basically very, very, very prototypical breakout pullback continuation. Let me go back into the setup chart. In a rather prototypical swing, range, dynamic area, muscling price, breakout, and well, off it goes for a whole new momentum swing. All right, again, this is as prototypical as it gets. Okay, now, so if that's our entry, if that's our stop loss, now where are we to locate our profit taking levels? Well, don't you worry, you are already familiar with the formula, so this is going to be pretty straightforward. If you remember, on the swinging model, all right, on the swinging pattern, if that was our entry, that was our stop loss, we were to use as our main level of reference as far as cashing out portions, a significant portion of the trade out, we would use the previous swing low. Okay, so around that area, actually a few pips before hitting that level, we would exit, we would cash out a significant portion of the trade. Let's say 50-60% of the trade around that area, right? Well, obviously, if we are looking into the breakout model, we don't have a previous swing low to use as a reference, right? Just because we are not getting this harmonic swinging pattern. So how are we to determine that main level of reference? Well, we are going to be using the entire width of the channel. Basically, you measure the distance between the upper range boundary and the lower range boundary and add that distance to the breakout point. All right, that distance to the breakout point, not to the entry point, but to the breakout point. Okay, and that takes you all the way there. That's where you would exit a significant portion of the trade. Again, just get this distance and add it up to the breakout point. Again, somewhere in there. And well, that's where you close 50-60% of the trade. Okay. Now, as far as the remaining 50% of the trade, well, you can still use the projection boundaries if you so wish. Okay, cashing out a little portion of the trade there, then a little portion of the trade there, and finally a little portion of the trade there. Again, as you can see, the projection boundaries. The projection bands. It's time for me to get a break now. Anyway, the projection bands are rather accurate, okay, rather accurate to read the exhaustion points in these swings, but they are not perfect. That's why you want to cash out a significant portion of the trade at the range with projection, okay, from the breakout point. And that's basically it, really. There is no secret here. Now, if you were to trade, let's imagine this, instead of being a sideways range, was a standard triangle. How do you measure the width of the triangle? Well, you simply take, let's imagine price followed some type of, this type of price pattern before the breakout. Well, you take the largest width, okay, the width of the range at its broadest point, so to speak. All right, and then again simply added it up to breakout point, okay, to the breakout level, and that takes you all the way down here. That's where you would exit 50% of the trade. And what if you were trading a breakout of a flat bottom triangle? Well, so let's actually draw a flat bottom triangle on my chart. Let's imagine price was doing something like this, okay, giving us a clear horizontal level of support and at the same time scoring lower swing highs, building pressure upon this horizontal line, okay, and effectively, well, that range area cannot hold price within anymore, and we do see eventually the breakout, right? So again, just take the widest part of the flat bottom triangle, added it up to the breakout level, to the breakout point, and that's where you want to cash out the majority of your trade. You would obviously still exit little portions of the trade all along as per the projection boundaries, but the majority of the trade is to be closed out at the width projection. Okay, pretty straightforward. There is no magic formula here, guys. All right. By the way, before I forget, please mind that in downtrends we are only interested in trading flat bottom triangles, and in the same way in uptrends we are only interested in trading flat top triangles. Okay, that means that we do not want to trade breakouts through the diagonal line. We want to only trade breakouts through the horizontal line. Please remember, okay, please keep in mind the nature of this pattern in itself. The idea here is that the market keeps on building pressure upon one specific level, which is based obviously the horizontal line. Okay, the idea here is that this line works as a last line of defense, whereas the market keeps on building pressure by scoring lower and lower and lower highs. Okay, basically keeps on building pressure upon this very level. Eventually, this level cannot hold the pressure anymore, and forced by the trend, it gives way, and that's why we see this momentum collapse. Okay, again, we need to think in terms of market dynamics. Okay, this is a pattern that signifies progressive market pressure upon one specific level. Okay, again, building lower swing highs, and eventually that level cannot hold the pressure anymore, and it gives way. And whenever it does give way, well, that's why we see momentum moves. Okay, again, same thing on flat top triangles in uptrends. A price tops out at that level, swing low, tops out there once again, higher swing low, tops out, higher swing low, so on and so forth, building pressure upon that level, and eventually, bang, off it goes for a momentum swing. Okay, that's the move you want to profit from, and that's why you want to see price. You want to see price breaking through the horizontal line. Again, not the diagonal line. Alright, now let's take a look into another example. We are looking into the sterling pound against the Canadian dollar weekly time frame. Okay, long-term outlook here. I like to show you guys examples on different time frames just to prove once again that this type of trading principles are universal, no matter the currency pair and no matter the time frame. Anyway, so we have a downtrend here, maybe not the most beautiful trend in the world. Certainly I would not go crazy for this trend. To be honest. We can see how, well, the 30 simple moving average gave us a rather flat angle there with a, price almost touching the 100 there and there. So like I said, certainly not the type of trend I would write home about, but at any rate, I want to show you guys a triangle formation. A triangle formation that takes place right off the dynamic area of support and resistance. As the dynamic area catches up, as the moving averages catch up with price, well, eventually the dynamic area pushes price to break free from this congestion area, okay, from this triangle. Please mind how the downtrending pattern is broken here. We now score, okay, we go from scoring lower swing lows and lower swing highs into scoring now higher swing lows. All right, this is a tip, let's say a trick or a recommendation, however you want to put it, as far as finding these sideways congestion areas. Whenever in your standard waving pattern you see that price fails to keep on giving us the lower swing highs, lower swing lows standard swinging pattern, look out for this type of congestion areas. For example, if price fails on the next bounce, on the next swing, to break through the previous swing low, and instead, well, we get either a horizontal swing low or even a higher swing low, well, search for you see this higher swing low there. Search for either sideways congestion areas or for triangles, such as in this case here. Whenever price fails to again continue swinging in the direction of the trend, that usually indicates that we've entered a period of sideways price action, okay? And therefore we can usually define again either horizontal lines, horizontal boundaries, or diagonal boundaries. This time around we find diagonal boundaries because price compresses sideways towards the vortex of the triangle. Okay. Anyway, so the breakout finally takes place. We would zoom into the shorter time frame, searching for our typical breakout pullback breakout pullback continuation pattern. And as far as placing the locating our final target or our main target of reference, we simply measure the widest part of the triangle, and we added it up to the breakout point, and that takes us all the way down here, rather accurately defining the optimal exit area before price retraces back up. Okay, like I say, not the most beautiful triangle, or rather not the most beautiful trend, but at any rate a valid triangle with a valid breakout in the desired direction, meaning to the downside. Okay, and well, that's why I wanted to show you guys this example. Okay, here we are with the mother of all trends, Euro against the Australian dollar daily time frame. All right, please mind how the trend has just come to an end, actually, or at least, well, it's jeopardized as I record this video. As per the last 2 days, actually, we can clearly define whether the trend keeps on pushing or not by reading price action around the dynamic area. We get the retracement. Simply ask yourself, does the dynamic area hold or not? Well, it certainly doesn't, okay? It certainly doesn't hold. Price breaches through in momentum. Now it's, well, almost touched the 100, okay? Momentum breakout to the upside. So, again, for the time being, we would stop considering further short entries on this currency pair. Anyway, I want to bring your attention onto this junction of the chart, okay? Price giving us a lower swing low, lower swing high, lower swing low, lower swing high, lower swing low, etc., etc., okay? And eventually here, I might have to zoom in a little bit more. Just give me a second. There we are. And eventually, what do we get there? A swing low and a horizontal swing low as well. So the waving pattern is broken. Now we have a clear double swing point of support, and obviously we are to wait for price to break from this sideways congestion area. Do you see how price effectively, we can just see that from a visual point of view, price has been simply flapping sideways. It's not trending anymore, all right? It's not trending anymore. Now price is congesting, or simply moving sideways, and the trend will not be resumed until we break through this level of support. All right, so we are to hold any further short entry. Okay, we will not take this bounce because the swinging pattern is broken. All right, again, I'll repeat that. We will not take this bounce off the dynamic area of support and resistance because the swinging pattern is broken. If we take this trade here, we would be trading within a sideways price action. In fact, it's a flat bottom triangle. Okay, we would not be trading within a trend. Instead, we would be trading within a range, right? And we don't want to trade within sideways ranges. We want to trade within the trend, right? And the trend, by definition, is not resumed until we break through this double level of support. So we will hold our horses. We will not take that trade, that bounce, until this flat bottom triangle breaks out. All right, let me mark that area with a horizontal line. All right, and that's exactly what we would do. We would zoom into the shorter time frames. Let me actually do just that right now. There we are. Let me scroll now forward to the actual breakout point. All right, there we are. As the breakout there, do you guys see that nice long, full body candle, breakout candle? Let me actually zoom in a little bit more. There it is. Do you see that massive full body breakout candle? That means that the actual breakout is taking place in momentum. You want to see that type of candles as the breakout pulls through. This is important, guys. The longer, the thicker the body of the breakout candle, the better. All right. So, solid breakout candle, then a little bit of a pullback, 1-2 bars, pulling back to well, retest breakout levels, and from there, well, off it goes, right? For a, well, as you can see, for a profitable swing. All right, entry as usual, right there. Stop loss, few pips above the pullback aspect. Okay, this pullback aspect, and well, off it goes. All right. Now, one quick note as far as the pullback goes. The number of bars within the pullback varies significantly. Okay, you can see tight breakout pullback continuation patterns where the actual pullback is just formed by one single bar. Okay, literally it's a 1 bar pullback. And occasion you see a rather wide, slow-moving breakout pullback continuation pattern, and you may see up to, I don't know, 5, 6, 7 bars on the pullback aspect of the whole breakout pullback continuation pattern, right? So, like I say, you cannot really define an appropriate number of candles within the pullback. So, it's more important that you actually learn to visualize the pattern in itself rather than to count the individual number of candles within the pattern. All right, again, that's going to be very difficult because every single breakout pullback continuation pattern is unique, just because every single trading scenario, every single breakout, it's in itself unique. Depending on how much momentum is carried over at the breakout, you will see faster or tighter breakout pullback continuation patterns, or if it's a rather slow breakout, well, the whole pattern will take a little bit longer to develop. Okay, so like I say, please try to learn to visualize the shape of the pattern as a whole. Okay. By the way, do not be surprised if on occasion you don't quite get any pullback at all. Okay, I repeat that, don't be surprised if upon the breakout, instead of getting a few green bars, okay, signifying that pullback, what you get is actually another red bar and another red bar and another red bar, and so on and so forth. And in like no time, you will realize that the move is completely gone without ever having given you the chance to jump on board. Okay, that's a reality, and there is nothing you can do about it. All right, I'm gonna repeat that. That's a reality, and there is not much you can do about it. I am sorry, but on occasion the markets are mean. They don't play along the rules, and you don't quite get that pullback, that little pullback to base your entry around. Okay, please mind that without the pullback, we cannot get this pullback, this breakout thrust low, and therefore we cannot get the continuation part, right? And therefore we get no entry, no valid entry, right? So, like I say, sometimes price simply takes off without giving us the chance to jump on board on time. Trust me, in the long run, it's more profitable to let those opportunities go without you profiting from them, but to score in the long run again a higher win-loss ratio by waiting for the confirmation of the breakout with those breakout pullback continuation patterns. Okay, otherwise, if you simply click on your sell button as price begins to tick below breakout levels, you will indeed be eaten by fake breakouts. Fake breakouts basically is a candle that simply peeps below the support line just to immediately after reverse back up within the next candle. All right, instead of getting a breakout pullback continuation pattern, we simply get a breakout and then a pullback, and well, the continuation part never quite happens. So you enter there, let's say you place your stop loss somewhere in there, and it gets triggered right away. Okay, so that's why you want to play it conservative with your entries. That's why you want to wait for those breakout pullback continuation patterns, even if that means that on occasion, again, you will miss straight breakouts that never quite pull back at all. All right. So if that ever happens to you, and it will happen, simply, well, smile, wave the trade goodbye, and, well, tip your hat to the market and search for your trading opportunities somewhere else. Next time around, you will get it right. Okay, now, and well, this video is already running too long. It's time to wrap it up. So just to finish off this video, I wanted to show you a general outlook of one of these trends following this this breakout model. Okay, instead of getting that harmonic swinging pattern, on occasion you get this type of swings, okay, followed by a congestion, the moving averages catching up with price, pushing price away. You get the breakout, yet another swing up, another congestion area, the moving averages catching up, breakout, swing, congestion, moving averages catching up with price, yet another breakout, yet another swing, and so on and so forth. Okay, again, once you gain a little bit of experience, once you gain a little bit of screen time under your belt, you will see that spotting those sideways price action, okay, those ranges, those consolidation areas, is not really that difficult. And once you find them, okay, once you spot them, simply mark the range boundaries. Here we have a triangle, here we have a sideways range, okay, here we have some sort of a mild flat top triangle. Just wait for the breakout, search for those breakout pullback continuation patterns of the trigger chart as close as possible to the dynamic area, and, well, off it goes for a whole new swing, aiming first of all for the distance, the width of the channel, and then cash out as usual little portions along the way as per the projection bands. Okay, nothing special here. Very straightforward approach, but again, once you master it, you will see how easy it is to try it. Okay, cheers.